Hello and welcome to FX Bully Academy. In this video, I'll be showing you one of my scalping strategies that I use intraday. As I always say, simplicity is more. Therefore, if you've been struggling with being consistent in the market, in this video, I'll show you step by step how I use this strategy to extract money out of the market. Therefore, let's dive in. In front of us, we have a trading plan. We have a higher time frame protocol. Then we have a lower time frame protocol. So in the higher time frame protocol, we have our higher time frames. We have M15, M30, and H1 time frame. And then what we are looking for, it is our market structure, simple market structure, whether we are bullish or bearish. Then the next thing that we are looking for an order block that creates an impulsive move. And we then mark that order block. Then we then drop to lower time frame. On our lower time frame with M1, M2, or M5, you will then choose one of these to then conduct your trading. Therefore, we'll then wait for the market to come back to our marked order block on the higher time frame. Then we then come to entries. In entries, we have two types of entries. We have risk entries and confirmation entries. Therefore, on a risk entry, on a higher time frame order block, the zone that we have marked, we will then put a limit order and then we put a stop loss above the zone. Or we'll use the three following entry techniques, which are confirmation entries. You will then wait for a CSD to form within the zone, and then you'll take your entry. Then we'll then put our stop loss above the CSD. The second one will be an engulfing candle. We wait for that to form. We then, as soon as the engulfing candle forms, we then put our entries. We then put our stop loss above the engulfing candles. Then we watch the market move. Third one will be you wait for a market structure break to happen on your lower time frame within the zone. And then you wait for a retracement to come into your fair value gap or your order block. Then you take your entries from there, and then we let the market move from there. Please note that this strategy works in all types of markets, whether synthetic indices, forex, futures, gold, metal, etc. So as always, please backtest, backtest, and backtest. What we have in front of us are the types of ways that we enter the market. The first one being the CSD, right here, where the market goes into our zone. And then when the market closes below consecutive candles, then we take our entry, stop loss goes above, and then we ride. Therefore, this is a true order block where market closes below consecutive candles. Whether bullish or bearish, it depends on the trend. And the second way is an engulfing candle, also known as one candle order block. Therefore, we wait for the market to close below the engulfing candle. Then we enter our market. Then we put our stop loss above, and then we watch the market move. The third one will be where we wait for the market to come to our higher time frame zone. We then put our limit order below and put our stop loss above. Then we wait for the market to tap that, and then the market moves below. And then the final one is where the market comes into the zone, pulls back, goes above the high, closes below a swing low, making our market structure break. We wait for the market to come to a fair value gap or the CSD to enter. We then put our stop loss above. I want us to look at the examples of how we use this strategy. At the moment, we are looking at V75. These are synthetic indices. So our rule says we are looking for a trend. If you can look this side, we have an uptrend, we have a downtrend this side. Therefore, we then look for market structure. Market structure suggests that the market needs to make a low, then you have a high, you then have a lower low, then you have a lower high if it is a downtrend, right? and then the opposite if it is an uptrend. So what we are looking for, we are looking to mark an order block that caused an aggressive move to the downside, right? So if we look here, the market drops, takes out a low. We then find right here we have an order block that caused the market to drop. When the market comes back in there, we are then looking for opportunities to sell the market, right? And then when the market dropped, it came out aggressively. We then mark also an order block that caused that. There you have it. Then we wait for the market to come back in that. Then we look for our entries to the downside, right? And then we go again, we look for an impulse move. So we have an impulse move right here that happened. We then mark an order block right there. We wait for the market to come back and we take our trade right there. Let's just say this is an M15 chart. Now, what do we want to do? Let's just say the market tapped in there. We're looking for an entry. We go to our M5. We then go back. And then what do you see? We then have consecutive candles coming into the zone. And then when the market closed below those consecutive 2 candles, that's a CSD. Therefore, you can just enter right there or wait for the market to pull back below that CSD candle. Then you enter. And then we have an engulfing one. Also here, entry, where the last candle over there, when the market closed below it, it's opening. Therefore, you were opening your entries right there. You are targeting these lows. That's your scalp. And then let's just go to a 2 minutes chart and go back to the very same area and see how you would have entered that. Same criteria. You have the market taps in there, gives us an engulfing candle on a 2 minutes chart. Therefore, our entries are coming inside here because we have tapped into our zone. We then take our entries, stop losses, they come above here. And then we target our lows. This is our first low that we will be targeting. And the market comes there, or you'll be targeting those lows somewhere between here. Then you'll find your target, and that's it. Let's just look into M1. So in M1, we are looking for the very same criteria. The market taps into the market. You have an engulfing candle. We close below that. You could have taken entries here. Stop loss goes above. Right here, you have a market structure shift. You have a high that is made. We pull back. We then violate that. We come and close. Below that, you have a market structure shift. And then you can take your trades. After the market closed there, you have a fair value gap right there. You have an order block here, CSD. You have taken your entries in this area or immediately after the market closed. So you have a CSD entry. You have a market structure shift entry. Also, you have a, what do you call this? An engulfing entry. When the market closes here, our entries, stop loss goes above there. We're targeting these lows and we are done. So that's how we get that. So let's just continue with the zones now that you've seen how that works. Now we have a market going out here, but it is not aggressive. It is just moving however. But then look at this, man. The market drops here aggressively. So as the market drops aggressively from that area, we could have simply marked that, right? And say this area is an area where we could want to look for opportunities, right? But also, we then see that following that, the market came out aggressively from this area. We then mark that, right? And then we wait for the market to come back in that area. And then we look for entries. Let's see what the market gave us there. We move to 5 minutes chart. Let's see. Right now, this is our 5 minutes chart. Now the market taps in here. What happened? It drops. We didn't find an engulfing here. There was no change in the state of delivery, and also there's no market structure shift. Therefore, we have nothing, right? Now the market goes above that high and then closes below this. Now you have a market structure shift. Therefore, you are ready to enter the market. Also, we have an engulfing where you can take entries right here. You have a CSD also in the very same area. You can then wait for the market to pull back into this fair value gap with an order block. That can also be an entry. Our stop losses are here. Then we are targeting these lows. That's your scalp. For those who like, what do you call this? Who likes stacking, that's where you stack your entries and there you made your money. These lows are taken out, but then your target would have been these ones. So I also want to throw you something else that I usually do in the market. At times when I see something of this kind on the 5 minutes chart, I will also scale in, right? What I will do is I would look for an area where the market moved out aggressively from the 5 minutes, right? This is just something extra. What I will then do, I'll use my fib from the top to the bottom to find premium and discount. And then above 50%, I'll look for an area where the market came out aggressively. I'll then put an order, I'll then draw an order block right there. And then I'll wait for the very same criteria that I wait for on the 15-minute zone. What I'll then do, I'll then drop to the 1 minute chart and wait for the market to come back in there, right? And then look for the very same criteria. What are those? The market taps into the zone, the market closes below that candle, that's an engulfing candle. I take my entries there. Or for a CSD, that's your CSD. When the market closes below that, my entries are coming in there, stop loss still goes above there, and then I ride the move. This is where I take my TPs, you see. So you then wait up until the market hits your TP. Let me check that out. Let's see, that's my TP. And the market will then take it out right there. So it's a nice scalping way of doing things. It is consistent and you can work with that. You see, that's one way of also doing things, right? Then let me take that out. What do we have? So we have this move when the market was going up. We're in the 15 minutes, but now, as you can see, it seems like the market turned from nowhere. But no, not. What you then do is you cycle up one time frame higher to a 30-minute chart, and you're looking for an area where the market came out aggressively. As you can see, this last candle over there, that's your order block, and then you take that and draw it out to the high. And then you wait for the market to come and tap into that order block, right? Take everything with the wicks. The market comes and taps in there, and then what do? We then drop to our lower time frame. We start from the 5 minutes. Then we wait for our entry criteria. The market taps in there. The market drops aggressively. What do you have? In this case, in this instant, what do I have? I only have an engulfing, right? So the market drops. We have an engulfing. We took out that low. We took out this low. So it's an aggressive move out. So your entries might have been here. Your stop loss there. And then you then target the lows, right? The risk to reward is there. Or if you didn't like that, we then go down to the 2 minutes chart. Let's see what we have. So the 2 minutes, the market taps, we drop below this low where we CSD, we can take our entries here. And then the market drops, you have your market structure shift, a pullback into a fair value gap and order block right there. And that would have been your entry. Or we can then drop to a 1 minute. Depending on what time frame you prefer. 1 minute, the market taps in there. you have a CSD entry, you have your engulfing entry right there, and you then look at the market dropping with you. I think this is also one way where you get your sniper entries. Now that's your V75. And as you can look, we tapped in there, and all of this was for our taking. That was your ultimate exit, right? If ever you were targeting the lows of your M15, then that was going to be your ultimate exit. So here we have our example 2. We have other synthetic indices here by World Trade. So what do we have here? We have FX Vol 80. We are in the 15 minutes chart. As we look here, we have a bullish trend here, and then what do? We are looking for those, the very same thing. So the market moves high, you have a break of structure, we have a low and a high that was broken, we have a break of structure. What do we have? We have an area where the market came out aggressively. On the 15 minutes, we mark that. And then when the market comes in that, what do we have? We then look for our entries. And then we have this area also where the market came out aggressively, right? We mark all those candles, the market come, tapped above, you would have find your entries there. And then we have this area now. Now, all of these consecutive candles, the market came out of that area, right? Let me do that. Yes. So the market came, it fell short, but let me see if we have something on the 30 minutes. So if you look at the 30 minutes, you have the wick right there. So the zone is even bigger. Then the market tapped into that, and you would have been looking for your entries somewhere there. So let me just go back to our lower time frames, and let's see if how would you have entered here, targeting those highs. 5 minute chart, the market taps in there, we're looking for engulfing. Now the market closes above this right there, plus also it's also a CSD. Your entries are here, and then your stop loss goes below there. Let's look at the 2 minutes chart. The 2 minutes chart, what then happens is that the market taps into our zone, it moves aggressively out with an engulfing plus a CSD. The market comes, taps on the engulfing, that's where your entries are, and the market moves out. Right, let's check the 1 minute chart. So your 1 minute chart, you have your engulfing here, your entries are here, your stop loss is here, the market moves. Now you have your market structure shift. You have a swing high, swing low is taken, a swing high is taken out. Now that that is taken out, we have a fair value gap, we have an order block, therefore the market comes in, your entries are here, your stop loss goes up below that, and that would have been your taking. Go back to a 15 minutes chart. Let's see if we can find another area. If you come back here, you then see that the market came out of this place aggressively. Therefore, that would have been your zone. You can go to a 30 minutes chart. If nothing, an hourly chart. So on an hourly chart, we then see that this becomes a whole big zone, right? You have a big zone, but this is just what happened right now, right? So what then happens is that you would have marked this candle over here where the market came out aggressively. When the market comes back into that area, that's where you'll be looking for your entries to go up, right? Let's go down to our 5 minutes chart, and let's see how we would have worked with that type of price. So market taps into the area and then sweeps liquidity, and then you will then wait for the market to give you your structure, right? So let's look into this and examine this one way or another. The market has tapped into our area. It has pulled back. What we have here, we have an engulfing, right? The market just went above that, but it is not, what do you call this? It is not one candle. The most powerful ones are where one candle engulfs the other candle. So those ones are powerful. But then when you see these ones, you can take them, but they're not really that strong. Let's just say we took this one, then we would have taken a loss right there. And then when this happened, see this aggressive move closing above all of these. Now that is what you're looking. Then you would have entered there. So let's go back. Let's see what else do we have. Now, if I go to a 15 minutes chart, I can clearly see that here I have a zone, right? The market went out aggressively. We are bullish. We took out a swing high. Then the market comes back into this area, right? That's our zone where we're looking for entries. Let's drop to a 5 minutes chart and see if we have found those entries. Now the market came into our zone and then it came out, right? Closing above multiple candles. Therefore, right there, we have an engulfing candle or an order block of hours. And we could have waited for a market to come back here at the top of it to buy, or you could have taken your entries as soon as that candle closes, and then your entries were there, stop loss here, and then you would have ride that to there. That's where we exit, or the 15 minute highs, right? So this is how this would have played. Now our third example will be on the gold chart. I always like to use recent price so that we don't cherry pick and look for something that looks nice. We just want to look at price, where it is, and we then dial back. As you can see, we see that the market is bullish on gold. Then let's see how many opportunities we would have found with this. So as soon as the market closed above this high, the market was bullish, right? Let's find an area where the market came out aggressively. You have that area over there. There's liquidity above it. You have a fair value gap right there. This is a zone where you could have been looking to buy your market. The market comes in here within New York. Would have bought that, and also from here the market came out aggressively. The last candle over there, it gave you some trades around 9:30 New York time. This was 7 and this was 9:30. Could have found your entries there to the upside, right? Then we come to the following day. The market goes up, comes lower, but doesn't tap our zones. It's fine. We move high. Our fair value gap are giving support. And then we have another area where the market pushes high. You're marking your areas. And then the following day, that's where our entries came from. The market taps during, let's see, what is that? This is Asian. And then it came back again around London. And then you would have found your trades right there, targeting these highs and eventually those highs, right? And then came New York, this side. When it was New York, what then happened is you then find your zone where the market left impulsively. This is where that happened. Good thing it has liquidity above it. Now, what time is this? Is 10. That is New York time. That's the time where you're looking for your entries. The market taps into that. That's where you're looking for your entries to go long, right? We then take out those highs, and the market comes back running back. You're looking for the next area where the market went out impulsively. This is where that happened. It happened at Asian time where the market pushed higher. It failed to break the high, And then this is what? This is London. The market pushed lower aggressively. And then New York time. What do you have? You have this area where the market dropped down aggressively, right? Coming back to this area again. When the market comes there, you're looking for your sells, right? And the market drops to these areas, right? And then as the market was going higher, let's just say you were looking for an entry. I mean, this is an area where the market went out aggressively. Therefore, when you get here, you could have been looking for opportunities to go lower, but then also if the market is consolidating, then you also have this area which the market went out aggressively. So the market is between those two zones, but opportunities were there nevertheless. Now, let's see how you would have entered. Let's just take this one up above here and see how you would have entered and look for your opportunities within that zone. We'll go to our 5 minutes chart and we'll go back and see if our entry criteria were given in the gold market. Now the market tapped in there and with an engulfing right there. Our entries here, stop loss there, TP below there. You're done. When the market retrace, you have a fair value gap, you have an order block right there. You could have looked for the very same thing on the lower time frame. Let's go to a 1 minute chart and see if there were any opportunities given. This is our gold chart, 1 minute chart. How would you have traded this? Pretty simple. We follow the rules. The market taps into our zone. First time it goes down, didn't take out the low. There's nothing. The market moves higher and then comes out aggressively. Now we have an engulfing. Also, yes, we have an engulfing there, but then a change of state of delivery will happen only when the market closed below here. So your first entry would have happened at this candle when the market retrace into this fair value gap. Your entry is there, or you then wait for a market structure shift, a change in the state of delivery. You have a fair value gap, you have an order block. That's where your entry was, and you were targeting these lows, and that's it, folks. That's how you would have traded that, right? And then here, you would have found the very same thing. We tapped the zone, the market comes below this low, right? Now here, we have created an engulfing of some sort, the market retrace, and you would have found your entries there to continue. So this is how we would have looked at the market if we were using this strategy. Most of us, the problem is that we want to overcomplicate things, and it is simple things that makes you money in this industry. So giving you a challenge, may you go out there, at least give it 3 months and trade this way and look at the market this way. Look for areas where the market came out impulsively. So look for an order block within that area. Wait for the market to come back in there and look for all those ways of entering the market. I've created a Telegram group for scalping, where we'll be using this type of trading. So I'll be also sending my setups there, the ones that I'm looking at, the zones which I'm looking at. If you are interested, you can join there, but then I'll be mainly focusing on synthetic indices. There's a link there. You might register with the broker and then we may trade together. Please subscribe and hit that notification bell so that when next time when I put another video, you might be notified. This is beautiful, man. Market came out aggressively, so we tapped into that. We closed below this area, our entry, stop loss. That's just a teaser.